at debt to equity, after the gearing, I think the other ones are simple, so we'll run a bit faster. Okay, so the debt to equity ratio measures the relationship between debt that has to equity capital of the entity. So we're looking at the difference between the debt element and the equity element of the company as a ratio. So just like we looked at debt to capital, this time around we are just looking at debt to equity. What is the ratio? And it's calculated as total debt as your numerator, then equity as the denominator. So it's a financial leverage ratio that compares a company's total liabilities to its shareholders' equity. So we are comparing the total liabilities, current and non-current, just like we saw the debt to capital. So we are comparing the non-current and the current to only the shareholders' equity, not the total capital now, like we saw in the last ratio. It indicates the relative portion of debt and equity used to finance a company's assets. Yes. So when you look at the debt and the equity, you're looking at what is used to purchase long-term investments, which are in form of non-current assets, long-term assets. A higher debt to equity ratio suggests that the company relies more on borrowed funds, because of course the debt is higher than the equity, which can imply greater financial risk, like we saw in the leverage ratio, while a lower ratio indicates a more conservative approach to financing. So using the same high-low method, that 50-50 balance, anything above 50 is high, and below, I think, is more, it's manageable. Okay, so it's a more comprehensive formula. We have total liabilities, like we saw as the debt, current and non-current, and we have total equity as the numerator. So where the total liabilities includes debt and obligations, which is clear, we have it current and long-term. Very simple. And the total equity refers to the available equity to shareholders, which includes common stock, preferred, retained earnings, everything on the equity section is what this ratio is all about. So let's go back and calculate this. This is very simple, and we'll just run over it and calculate the ratios. It's quite simple. Once I hear these ratios, I always get excited. Sorry, let me share my total screen so that I can be on the same page. Okay, so I think I still have the issue with this numbering. Let me change it now to 2021, 2022. So as usual, we'll run. So you help me with the 2021 and 2022 while I do 2021 simply. So our total liabilities, there's no need toggling through the screen. Let me just come here and pick for the 3 years. Very simply here. Okay, this is a formula. That's why. All right, so 945, 1, 2, 3. Okay, so we have total liabilities. Then what is our total equity? So our total
is it in percentage?
No, it's a ratio. Debt to equity is a ratio. We want to see the ratio of debt, so the percentage to that of equity. So when you see debt to or anything to, just know you are doing two numbers. So just like we have it here, yes. So just like we have it here, debt to capital. So we'll do it like this exactly. But this one is debt to equity. So total liabilities. Then let me pick. I can also, in that same sheet, pick our total equity. This is our total equity.
So I have a 0.93 to 1 and 0.98 to 1. It's quite high.
Really? Wow. And something is wrong with bankability. Okay, so let's do the debt to equity ratio. Okay, so let me have this to this. So I have 0.90 is to 1.
So the other is 0.93 to 1 and 0.98 to 1.
93 to 1.
0.98 to 1.
8 to 1. Yeah.
Okay, so 1. All right, so let me drag and confirm exactly.
Yep.
Wow. Wow, exactly. So let's discuss this now. It means, before we go to the meaning actually, so we are saying that our liabilities is 90% of our equity. That's high. Julie just said that. Julie just said that. That's high.
Yeah, it was showing in the other report,
Exactly. Aisha, what do you think? Don't you think it's high too?
It is high.
It's extremely. It's highly
Highly geared.
Is it highly geared?
No, we'll not use geared now because gearing have to do with external issues. So this one is not
internal.
So this one is internal. So our liabilities is internally geared. Maybe that one will work now. It's internally highly geared because liabilities is 90% of your total equity. So if you pay off your liabilities, the equity holders are only going with 10%. In fact, in 2022, they are only going with 2%.
Yeah.
It's something like that I talked about earlier. Almost.
Yes, exactly. That you are speaking to the debt to capital. Yeah. Okay, so let's look at what it means quickly if it aligns with our thoughts and our deliberation. The debt to equity ratio reflects how much debt a company is using to finance its operations relative to its equity base. Yeah. A high ratio indicates increased financial leverage, meaning that significant portion of financing comes from debt, which is true. Since we have 90%, is actually coming from debt, while a lower ratio suggests a reliance on equity funding. Exactly. So what's the implication? A higher DE ratio implies a greater financial risk for the company. Yeah, so from the result we saw, as it must service its debt obligations regardless of its earnings. Of course. This can be particularly concerning in economic downturns. That's true, where cash flows may be strained. So where we have 2021, 90%, is concerning, just like we said, because you are using all your earnings, retained earnings, reserves to service your obligations. That is quite high and can strain cash flow. While a lower one indicates lower risk, which may appeal to conservative investors, but could also suggest underutilization of financial leverage for growth. Yeah, so when you have something lower, maybe lower than 50%, it's better, it's safer, even though some investors will look at it that you are not leveraging debt. You are not taking debt to grow. Well, it's good to grow, but then you have to be conservative and also balance it when you are growing. Don't be over high. 90% is quite high for the industry we found ourselves, since it's not a bank. And what are the causes and effects of a high debt and equity? Like we see, debt to equity is high because they are looking at aggressive financing strategies, expansion efforts funded through debt, or lower equity due to retained losses or share buyback. So this could be the causes. And in Dan Kabir's case, he didn't have any retained loss. There were no loss, or the retained earnings were not negative. And we didn't have shareholders buying back their shares. Share buybacks involve shareholders buying back their shares from equity or debt that were sold to. So we didn't have such scenarios in this case. So it was just more of aggressive financing strategies and expansion efforts that were funded through debt that caused Dan Kabir's high gearing ratio. What are the effects? Increased financial risk and financial distress. Exactly. Higher interest expense. Your interest coverage ratio or the interest expense will be higher because you took more debt. Potential difficulty in raising additional capital. Exactly. So when you ask shareholders to provide more capital, they'll be like, what is there for us? We have less than 10%, 2% in 2022, and you want to borrow more money. We are not going to provide it to. So that's the risk, difficulty in raising additional capital, because shareholders look at their investments as not yielding or very low. So those are the effects. Why a low one is caused by conservative capital structure. So something balanced, maybe less than 50% or 50 at most, and reliance on equity financing or accumulation of retained earnings, where you have high retained earnings that is not swallowed up by the debt or obligations. And the effect is greater financial stability, lower interest costs, but potential limited growth opportunities. So what drives people to take debt is that growth opportunities and expansion. But if they don't leverage debt effectively, it's going to be catastrophic for the company. So in driving growth and expansion strategies, companies need to be very careful and leverage debt effectively. In conclusion, the debt to equity ratio is a vital measure of a company's financial leverage and risk profile. So comparing your total liabilities to equity, stakeholders can assess the level of debt financing in relation to what the shareholders want. So the same word that keeps coming is balance. Balance is crucial for ensuring financial stability and growth potential, allowing a company to navigate economic challenges while optimizing its capital structure. So this is very simple. It's a formula that is straightforward and I love it. I don't know if we have any questions, contributions, or observations. Any questions? Okay, I think we are okay and we are good with it. All right, Aisha, I heard you. You want to ask something?
No, I said none from me.
Okay. That's fine. So let's go to another simple ratio, but also nice ratio. It's called debt ratio. This one is not debt to equity now, it's just debt ratio. It's a financial metric that indicates the proportion of a company's total assets that are financed through debt. So the asset of the company is the denominator, while the debt is the numerator. So in the last one, we looked at debt to equity. Now, this one has nothing to do with equity. It's looking at debt, which is your total liabilities by your total assets. Very simple ratio. It helps assess the company's financial leverage and stability by showing how much of its assets are funded by liabilities. Exactly. So the assets are funded by liabilities. I want to see the ratio or the percentage. So this is not a ratio now, this is a percentage. We're looking at the debt to the total assets. The higher debt ratio suggests greater financial risk as a larger portion of the company's asset is financed through debt. Exactly. So the formula is clear. We have our total liabilities as the numerator and our total assets as the denominator, where total liabilities is current and long-term, and total asset includes current also and non-current. So total liability is current and non-current. Total asset is also current and non-current. Quite funny. All right. So before we go back to
total liability is current. Come again. Total, what did you say?
Okay. So total liabilities is current, though the former term that is used is long term, but currently you don't use long term liabilities in IFRS. You say current and non-current. While total asset too is not current and fixed, it's still current and non-current. That's why I sighed and smiled. Yeah.
So it's total, it's just total.
Yes, just the total. So let's look at that quickly and see the percentage. So this is not a ratio now, this is a percentage. We are seeing the percentage of the debt to our total assets. Okay, so let me change this quickly to normal. So we just pick the figures directly. There's no need wasting too much time. It's straightforward. So we have this is our debt, which is total current and total liabilities. So we have it here. So let's go to our anchor view and pick our total assets. So this is total asset, but we're not picking beginning, we are picking this too. Okay, so these are our total assets. Exactly. All right, so we have this as the figures. So our debt ratio just a percentage. So we want to see the debt percentage of our total debt to our total assets. So this divided by this. And we have it as a percentage. So 56% of our liabilities is a composition of our total assets. So the total asset we own, 56% is given to or is owned by liabilities. Exactly. So can you do 2021 before I drag? Let's see the percentage of
56.05 and 56.
Okay, 56.
Both 56. 56,
Yeah.
56.
Yeah.
Both 56.
Okay. Aisha, you agree too?
Yes, the same thing.
Okay. So let's see. Exactly. So we're both aligned. So 56% of the liabilities is not high, is not low. I'll call it moderate, but then the assets is 44% of the total composition of the 100% asset and liabilities. But 50-50 is still good, though this is not too high, but they need to check it. They need to start checking their liability and ensure that it's not out of control. So what does this mean? It provides insight into the company's financial leverage, revealing how much of assets based is funded by debt. So the asset base of the company is the company's investments for long-term economic benefit. But then what is taken out of that economic benefit is very crucial, and those liabilities need to be checked and ensure it's not out of control. So a higher ratio indicates that a significant portion of asset is financed through liabilities, while a lower one suggests a more conservative approach with less reliance on debt. So the balance of 50-50, so we saw 56 is still okay, but the total asset 44 is a bit low. 50-50 and a lower total liability, maybe 47, 45 is advocated and better. What is the implication? A high debt ratio implies a higher financial risk, as the company may face challenges in meeting debt obligations, especially in economic downturn. So where we have debt ratios of above 80, 70, 90, it will be challenging, because you may need to sell off some of your assets to pay liabilities if it becomes tough for the company, and you don't want that situation. So during economic downturns, where debt ratios are high, especially for some industries, is not advisable. Investors and creditors may view a high ratio as a sign of potential instability. Exactly. So they will look at the company as if stable, their debt is swallowing their assets. Conversely, a lower debt indicates a more secure financial position, which may be more appealing to investors seeking lower risk. That's true. So what are the costs and effects? It's still the same: aggressive borrowing for expansion. So everything boils down to expansion and growth, primarily, which is the reason. And high levels of existing debt could cause it, or a relatively low asset base. Exactly. And the effects is clear: increased financial vulnerability. You are vulnerable to losing what you own in form of assets, because you have to pay off obligations when they fall due. Potential cash flow issues, challenges in securing additional financing. When the people you go to meet to borrow money see that your debt are high, they are skeptical, because they will think you use the same money to, or crash their money the same way you are crashing the company now. They may be skeptical to borrow the company money. Well, a low debt is caused by conservative borrowing practices, higher equity financing, or growth in asset-based value without corresponding debt. So where the asset base is growing and the debt are reducing, it's a good development, and the causes are those are the causes of a low debt ratio. Bad effects include greater financial stability and lower risk of insolvency. Exactly. But potentially missed opportunities for leveraging debt to fuel growth. So the conclusion of the matter is balance. So even if you want to grow, you have to balance it and don't overgrow and outdo the company's capacity. It's very important. So in conclusion, the debt ratio is an essential measure for evaluating a company's financial structure and risk profile. By assessing the proportion of total liabilities to total assets, stakeholders can gauge the level of financial leverage a company employs. Exactly. So that balance we spoke about is important. So your total assets to total liabilities should be at least 50%. So we are seeing 56% in Dan Kabir. He's gradually sliding to a higher liability than his asset, which is not advisable. So they need to calm down. Even if they want to grow, they should grow and also retain control. So this same word keeps showing up. Balance is vital for ensuring long-term financial health, and it enables a company to efficiently or effectively manage its obligations while pursuing growth opportunities. So if you are sliding towards 60% debt, 40% leverage, quickly make the profit, maybe during economic boom, and run back to 50%. Pay off your debt, come back to 50. Drop it down, if possible, to 60, 40. That's advisable and smarter investment and a safer threshold to hold. All right, the ratio is quite simple and very interesting. Do we have any questions or contributions?
No, not for now for me.
Okay. All right. So let's run. That's good. I like these ratios. It's only gearing that is actually challenging. Gearing is stubborn, but these ones are simple. In fact, when I'm sleeping, you wake me, I can remember the formulas. I'm telling you. All right. So let's look at interest coverage, or it's called interest cover. One of the simplest also. Interest cover measures a company's ability to pay interest. So your fixed dividend, all those borrowings, you need to pay your interest. Any long-term borrowing, fixed interest, you must pay the interest. So it measures the company's ability to pay interest on outstanding debt. And it indicates how easily the company can meet its interest obligations from its operating income. So the operating income is your earnings before interest and taxes. We'll be looking at that in the formula. So a higher ratio signifies a greater ability to cover interest expense. So when you have coverage of 1, 2, 3, this one looks at how many times your operating income can cover your interest expense. So it's not a ratio, it's how many times it will cover. It signifies lower risk of default. But the lower it is, the higher the risk of default. So we have the interest covers earnings before interest and taxes by your interest expense in the SCI. So where the earnings before interest and taxes includes the company's operating income before any charging of interest or taxes or depreciation and amortization or any expense related to that. And the interest expense includes finance cost. So where you see finance cost, you see interest, they are the same thing. They are incurred by the company for borrowing money. So those are fixed interest you must pay. Very important. Okay, so quickly, let's use Dan Kabir to quickly crunch these numbers very, very fast. So we need to... Yeah, please go ahead, please.
I was off for a few seconds and sorry, what are we calculating? What are we calculating?
I understand. So we're looking at interest coverage. Yes. Go ahead, Aisha, please.
Interest, can you imagine? Interest
cover, yes. That's what we're looking at.
Can I take it back a bit?
Okay. So that's the formula.
Okay.
Will you do a brief recap for us, Aisha? Is it necessary? Will you need that? Julie?
Interest cover. EBIT. Over.
Yes.
What is interest expenses?
So the finance cost.
Okay.
Yeah, so you borrowed money and that interest expense that accrues every year to the principal is the interest expense. So when you see finance cost, that is interest expense.
So now the interest cover says it measures the ability of the company to pay interest and other outstandings.
Exactly.
And then the higher the ratio signifies the greater ability to cover those interests. Like that's
Exactly.
Mm.
Get it now, Julie?
Yes, yes. And it's measured in ratio or percentage.
In time. How many
time.
times? Yes. How many times
Time.
yes. How many
Any
times
before
your
interest
operating
and
income?
tax. Okay.
Exactly.
Mm-hmm.
Exactly.
It's a very
So,
interesting ratio. I think I like it itself.
yes. I like it too. It's very straightforward. It's very straightforward. So let's quickly look at Dan Kabir and pick the earnings before interest and tax. So what is our earnings before interest and tax? Yeah.
Mm.
Let me quickly pick it so that
I think for 2020, I would pick 104,500.
exactly. Julie, do you agree?
Yes, exactly.
Okay, so Julie agrees too. Good one, Aisha. Okay, so let's go to our Excel. So this is our EBIT and this is our finance cost. So don't mind the interest expense acronym. It means the same thing. So let me remove the negativity since we want to see how many times our operating we are able to cover this if we are safe. Okay, so the interest, I prefer calling it interest cover. That's what I know it to be since secondary school. It's when I
2021.
yes.
For 2021,
So
I have 4.5 times. 2022, 6 times.
Okay. Aisha, Alpha, do you agree?
5 times for 2022.
Julie has 6 times. So.
But wait, maybe I'm getting. Let me see what I
It's
picked.
4.7, 4.74.
It's 166,980. It's 166,980 divided by 27,830.
So I picked wrong figures.
132,192.
Look at the figures. So. Julie, where did you see 166?
Right before. Where did I get? Okay. It's still my eye. Okay.
But she has woken up now. She's sounding lively now. So she has woken up.
Yes.
So 2021
it's
is
132. Yes, 132. It's true. 132. 192 divided by. That's 5 times.
Mm-hmm.
5 times.
Okay, so for 2022 is 5 times, right?
Yes, 2021 is 5 times also.
2021. Okay, so 5 times. 5 times. Okay. All right, fantastic. So let me drag exactly. So we have the same, we're on the same page. So Dan Kabir is doing good. He borrowed money and he has capacity to pay interest and so we don't have issues. So anything above 1, 2 times shows the company is doing well. Anything less than 1 is where there's a challenge. And what does it mean? It means the number of times. So you can see the times here. So don't do percentage, don't do ratio. This is 2. So the interest cover, look at how many times the company, yes, can pay its interest expense with its earnings. The high ratio indicates strong ability, like Dan Kabir is very strong to cover interest expense. While a lower one, anything less than 1, suggests potential difficulties in meeting these obligations. What's the implication? Is generally a higher ratio, generally seen as favorable, indicating that the company can comfortably meet its interest payments or finance cost, which is reassuring to creditors and investors. Yeah. So external borrowers want to know that their interest is coming and their principal is safe also. Conversely, a low one may raise concerns about the company's financial stability, potentially leading to higher borrowing costs or difficulty in securing new financing. Exactly. So when the ratio is lower, you keep accumulating interest and you must pay. And in the event of winding the company because you cannot pay the debts, these people have a claim on your assets. So the borrowing cost becomes stricter and much more terrible. And in such situations, you may not be able to get new financing because it'll be like, who will borrow you more when the one you even borrowed, you have not been able to settle. So a low ratio is not advisable. What are the causes of a high interest cover? Strong operational performance, efficient management of expenses, and low levels of debt, which we saw in the case of ICAN Kabir. Why the effects is clear: greater financial stability, exactly, improved credit ratings, and it's easier for the company to access capital, internal or external. Why a lower one is caused by weak earnings performance, high levels of debt, significant interest obligations relative to income. Maybe they've accumulated a lot of those interests and there's no forgiveness of the debt or the interest. So they keep accumulating it, and the effect is increased risk of default, inability to pay, potential cash flow issues, challenges in obtaining more financing to mitigate that issue. So what's the conclusion? This interest cover is very critical. It's one of the main ratios that investors use to check the financial health and ability to meet interest obligations. So by evaluating the relationship between the operating expense and interest, operating income and interest expense, stakeholders can assess the risk associated with the company's debt levels. So maintaining a healthy interest coverage ratio is essential for ensuring long-term financial stability. Exactly. So make sure the earnings are high and the interest expense are low, and you have the confidence of both investors and creditors. This is very simple and it's a straightforward ratio, and I love it. I don't think we have any questions, but if we do, please go ahead as we look at another very simple one. Any questions? I believe our silence means we understand. Okay, let's run to equity ratio, which is known as propriety ratio. So when you hear proprietary, you are talking about the owners of the company, proprietary, proprietress. I used to hear that word when it comes to owners of schools, the proprietress or the proprietor. So these are the primary owners of the company. They are not debt people now. So this ratio measures the proportion of the total assets that are financed by shareholders' equity. It indicates the level of financial leverage the company is using and reflects the degree to which the company is reliant on equity as a source of finances. So this one is an inverse of the debt ratio. So the debt ratio, we looked at total liabilities divided by total assets, while this equity ratio is total equity divided by total assets. Very simple. So a higher equity ratio suggests lower reliance on debt and greater financial stability. And this is the formula: total equity divided by total assets. Where we have total equity, we include the common stock or common shares, preferred stock and retained earnings, reserves, share premium, and the total assets is current and non-current. Very simple. Okay, so let's calculate fast and run. We have two more popular
Is it measured in percentage or?
Yes, just like the debt. So this is a percentage, and you want to see how much percentage of equity is financed by total assets. Exactly. So let's go. We already have our numbers. It's just to copy and paste. It's very simple to derive. So let me go to our total. Where do we have equity? Okay, so we have equity here. Let me just copy it. There's no need going to down Kabir then. Let me go to where we have our liabilities. Sorry, our assets. Okay, so I have assets here. Okay, so that's fast. Very fast. So our equity ratio is now this divided by this. So I have 63%. So can I have 2021, 2022 for comparison?
2021 is 60%.
60%. Aisha, do you agree?
2022 is 57%.
57%.
Yeah, I did total assets divided by total equity. Sorry.
Okay, we did the inverse. All right, let's look at the formula again. Yeah, so total equity divided by total assets. Yeah. I like this. The equity holders are doing well. 63% is good. It shows the Bank Abiri's equity holders will smile to the bank. 63, 20, or 37. 63, 37. It's not bad.
57% for 2022. Yeah.
2021.
And 60, yes. It is correct.
Okay, so let me, exactly. So I've dragged and we have the same figure. Thank you very much. All right, so let's go and see what it means. It means that a company's capital structure and the financial health is tested here. A high ratio indicates that a significant portion of the company's asset is funded by equity, implying lower financial risk. Exactly. So the owners of the company, in fact, a comfortable control position, 63%, and they have lower financial risk, and it's a very good position. And conversely, a lower one, less than 50, 40, 30, indicate higher leverage and reliance on debt financing that they are using to fund their assets, and is not advisable. First, the implication, a high ratio is often viewed favorable by investors and creditors, as it indicates a more conservative capital structure and lower financial risk. So anything above 50, 55, 60 is a good ratio and is high also. This can lead to greater stability in times of economic downturn. Exactly, where there are no booms, profits are not coming, shareholders are stable. They are happy that their company is in their hands. Conversely, a lower one below 50, 30, 20, 10 may suggest higher financial risk and increased vulnerability to insolvency. Yeah, it's that bad because you need to pay debt holders first. And in the ranking of liquidation and insolvency, you must pay debt owners restrictive covenants first before shareholders go with the crumbs or with the remains. So during times of insolvency, if you have a lower equity ratio, the equity holders or shareholders are vulnerable, especially if the company faces cash flow challenges. While a higher equity ratio is caused by strong retained earnings, low debt levels, or recent equity financing. And the effect is increased financial stability, lower risk of bankruptcy, and favorable credit rating. And the low equity is caused by debt financing, operational losses, reducing equity, aggressive growth strategies funded through borrowings, and the effect is financial risk leading to inability to meet obligations and greater likelihood of experiencing liquidity issues, and which may even culminate in insolvency and shutdown of the company. So it's risky to have this ratio very low. So in conclusion, this ratio is an indicator of the financial structure, revealing the balance between debt and equity, because you use some money to finance the assets, and it is an assessment of the proportion of total equity to assets which stakeholders use to evaluate a company's reliance on shareholders' financing and its overall risk. So this word here is balance. Balanced equity to the asset is essential for long-term sustainability and for fostering investor and creditor confidence. Quite a simple ratio and very straightforward. Any question? I don't think we do. It's very clear. Okay, so these last two are very unpopular and I will run through them. Why did I present them? The examiner has not tested them so far, actually. Well, I brought them here because ICAN is full of surprises. Anything is allowable. And from the 21 editions, he has not tested any cash flow ratio. And this ratio is one of the ratios that links the cash flow statement. In fact, he has not bought cash flow statement in any of his 21 diets. So who knows whether this diet will bring it. So just get prepared and have the information at the back of your mind that this ratio exists. But he has not tested it, and take note, it's not popular. It's just for your knowledge, and it's good. Knowledge, they say, is power, so just know it. Let's run through it. I think we have 10 minutes more to round up. And let's close out on long-term solvency ratios. Okay, so cash flow to debt ratio measures the company's ability to cover its total debt obligations with its operating cash flow. So from your cash flow statement, you have three kinds of cash flow. Who knows them? I believe you can still remember them now. We are still writing CR, or we have passed CR.
The operating, investing, and financing activities.
Exactly. So now in this ratio, we are looking at the operating. So you can see from the formula, it measures the company's ability to cover its total debt obligation with operating cash flow. So not investing now, not financing, but only operating. It indicates the proportion of cash generated from operations relative to total debt, providing insight into a company's liquidity and financial stability. So a higher ratio signifies stronger ability to meet debt obligation, reducing the risk of financial distress. So the formula is clear. Operating cash flow divided by total debt. Where operating cash flow is cash generated from a company's normal business operations, while total debt include both short-term, which is non-current, and current liabilities. So take note of this. When a cash flow statement is not provided to you, maybe under exam conditions, and you are asked to calculate this ratio, you use EBITDA. EBITDA is a perfect position. So where there is no cash flow statement provided, EBITDA from the statement of comprehensive income can be used as a substitute, though not a perfect picture, but it's a substitute that depicts cash flow operating, cash flow from operations. And the key reasons is because the EBITDA exclude cash items like depreciation, amortization, and any non-cash movements. It reflects operational performance, and it also shows earnings generated purely from operating activities, aligning with the cash flow from operations intent. So before financing and investing activity, EBITDA doesn't include interest and taxes, keeping the focus on operational earnings, similar to cash flow from operations. While it's not perfect, like I said, it's not a perfect, but it's just a substitute. It serves as a proxy. So under exam condition, you may not say a cash flow statement. You want to, how do I calculate this? If he asks, just know it's a proxy for cash generated by the business. So do you have any questions on this so far? I think Aisha was trying to say something.
No, I was just reflecting on the cash flow statements that, we add back depreciation and some current taxes. So that was when the EBITDA made sense to me.
Exactly. Julie, does it resonate with you too?
Putting cash flow.
Yes. It's very unpopular anyway, so don't worry. It may not be tested, but just for you to know. Okay, so she didn't grab it. So let's go back and see if you can grab it. So it's looking at how much you have running day to day. Your cash flow statement looks at, let me go to Dan Kabir. Maybe the cash flow statement will help you. Don't forget there's a cash flow statement in Dan Kabir. We've just been using the first two financial statements. So this is the cash flow. So we have...
Where's the cash flow statement?
Is it Dan Kabir now? Can you see
it?
Where is it? Okay.
Page 3. Yes. So IAS 7 provides that indirect method is used. Yes.
So what figure are we supposed to pick?
Okay, so you see your net cash flow from operating activities. This is 2020, 2021, 2022. So this is the amount you pick. Exactly.
Yes.
93, 91, and 105.
Exactly. So let's pick it and go calculate this.
Operating cash flow divided by total debt, right?
Yes, total debt, which is current. Yes. So
okay, current liabilities. Okay.
Total liabilities, so not only current, total.
Where should it be total? Where should it be total? Because operating cash flow is something. Okay.
So you're looking at the company's ability to cover its total debt obligations with your cash, and your cash flow exclude non-cash items. So the cash flow statement provides from operations provides only those cash flow items. Like Aisha said, that it makes more sense when you are excluding non-cash items. So you want to offset obligations. If you can offset obligations with your cash flow from operations, then it shows you are very strong in your debt management practice. So that's just what it means. It's very unpopular anyway.
Measured in times or percentage?
It's not times, it's not percentage. So anywhere you see cash flow to, you have to provide the ratio of that one to the other one. Cash flow to debt ratio.
Yes, cash to debt ratio.
Cash. So we want to see how many is cash flow to debt. So if we do like this, we just say this is to this. So we have 9%. So it will now be 0.09 is to 1.
2022 has 0.09 also.
0.09.
21 is 0.09.
Okay. Out of 2022?
0.09.
For 2022 to the same?
Yes.
Okay, 0.09. Julie, do we agree?
I haven't calculated it. It should be. It should be.
Okay. So before I confirm, please calculate it. Let's be sure.
Yes, 0.09. Yes.
0.09.
Okay. Okay, so let me drag. Exactly. So 9% of our cash flow is to our total debt. Very, very low. Just 9%. We cannot cover our debt with our cash flow from operations. That is what it means. It's too low. And if we use EBITDA, we will also have the same almost close or not too far a result. So what does it mean? Before we go to the document, it means that 9% of our cash flow is what we can pay off our debt, and it's not possible. It's too low. Extremely low. So we are looking at cash flow from operations and without any dilutions of non-cash movements. If we can pay off debt obligations, we can't. That's what this means. We can't. So let's look at what it means officially from the. So it means that it reveals how many times a company can pay off its total debt using cash flow from operations. So from this result, we cannot pay. It's clear. A high ratio indicates the company has sufficient cash flow to cover its debt, whereas a lower ratio suggests potential challenges in meeting these obligations. And what's the implication? A high cash flow to debt ratio is generally viewed positively, indicating that the company is generating enough cash from its operations to handle its debt commitments. So I think banks and some other investment companies that deal more with cash will have this ratio positive, but not companies that don't really deal with cash from operations. I doubt if they will be able to have this ratio favorable. And the implication is that it can enhance a company's creditworthiness and reduce borrowing costs. So they just use the cash to finance operations and they don't need any borrowing. Very few industries can meet up or use these ratios positively, or this ratio. Conversely, a low one may arise or raise concerns about the company's ability to meet its debt obligations, potentially leading to higher borrowing costs or difficulty in securing new financing. Exactly. What are the causes and effects of a high cash flow to debt ratio? Strong operational performance, efficient management of cash flows, or low level of debt. Effects: greater finance or financial stability, improved ability to invest in growth opportunities, and lower interest rates on borrowed funds. Why a low one, like we saw here, is weak operating performance, but then it still depends on the industry. So take note, and the ratio is not a popular ratio, and it's even more of an American jurisdiction ratio. Yeah, the North American area gravitates. If you look at the UK, where we gravitate towards, it's not frequently tested. It's just maybe for academic purpose. And the low cash flow to debt ratio is caused by high levels of debt or cash flow issues. The effects include increased financial risk, potential liquidity problems, and a greater likelihood of defaulting on debt obligations. So in conclusion, it's an essential measure of a company's liquidity and financial health. So by comparing the cash flow to debt, total debt, stakeholders can assess a company's ability to manage its debt effectively. So maintaining a healthy cash flow to debt is crucial. So we need to make our investors and stakeholders, creditors have confidence in us. So like I said, disclaimer is not a popular ratio, but you just need to be aware. So you know something about the cash flow from operations in case you see cash flow statement for the first time in the exam, and the ratios towards these areas are tested. Very important. So finally, it's already 10, but let's just run through this last one. It's very simple. It's called long-term debt to capitalization ratio. Also very unpopular like the cash flow to debt, but it's good we are aware of it. It assesses the proportion of a company's long-term debt in relation to the total capitalization, which includes long-term debt and shareholders' equity. It helps to assess or evaluate financial leverage and the degree to which it relies on debt to finance operations. The high ratio indicates greater financial risk associated with higher debt levels related to equity, and this is the formula. We have long-term debt, shareholders, or long-term debt as numerator, shareholders' equity as denominator. So the difference between these ones and the other ones we have calculated is you don't include preference. Take note of it. It's an internal ratio, and that is why it's not popular. So in the long-term debt, you don't include preference. In the short term, in the shareholders' equity, you don't include preference. So why are we doing that? We're looking at our internally debt and capitalization without external dilution. So the long-term debt is non-current plus current liabilities, while the shareholders' equity is exclusive of preference stock. Take note of that. That's just the difference between the other ratios we've calculated. So look at it. Long-term debt include all debt that are due for above 1 year, excluding preference. Shareholders' equity also is excluding preference. It's not popular, so take note, except if you see it. He has never tested it in his exams. Okay, so let's calculate it quickly. I think from our on the previous calculations, we can just take the total debt. So our total debt is our total liabilities, and this is it.
So now we're removing preference dividends.
Yeah, so just remove preference dividend from the denominator for me. We've been including it, so remove it.
Total
equity. Yes, no, from the total equity. No, this total liability is just current and non-current. Don't forget, there's no preference.
Yes, that's what I'm saying. We'll remove preference dividends.
Yes, from the denominator, right?
From the long-term debt.
No, don't forget this total liabilities that doesn't have preference stock.
In the computation, we have current liability.
Okay.
The current liability, I can see preference dividends, which is 47,250 for December 2020. So I'm asking, do I remove that?
Okay, so let me get what you are saying now. So you can see this non-current. This is our total liability. So see it here, 620. Is this not our total liabilities?
Yes, 945,000 for December.
Yes. So we don't have preference in it now.
Preference dividend.
Oh, okay. No, it's the stock. Look at the definition. You leave the dividend. Dividend is fixed. So look at the definition. It's just the preference shares that you exclude.
Okay.
Yeah. So you leave the dividend. Yes, it's the shares. So where is it again? Just see it excluding preferred stock.
Okay.
Only the stock, yes. So when it comes to our denominator, this shareholders' equity, that's where we exempt the preference stock. Yes.
Okay.
Yeah. Okay, so let's go here now to the SCI. Okay, no, to the SSFP. So we have our total equity. So this minus preference, 105 minus preference, this minus preference. That's what we'll do. Let me just take.
Let me give you one.
Okay, what did it give you?
1 for 2020.
One. Okay, so let me just take this, validate what you did. So this is the shareholders' equity versus preference. I hope Julia has not dozed off. She's quiet.
I'm watching the calculator.
Okay, she's awake. I think Aisha is correct. We call this net equity since I've removed preference. Okay, so total liabilities, this is to this. Exactly, I had her say 1. So it's 1, it's 2, 1. Okay, so can I have 2022?
Also 1.1, 1.03.
Okay, 1.00 is to 1.00. 1.00 is to 1. Okay, 1.03.
Yes.
Like this? Okay,
Yes.
what of 2020? This is 2020. This is 2021. This is 2022. Okay, so what of this 2022?
I'm working on it.
Okay, Julia, are we on the same page?
I am watching. I've lost strength.
Since the ratio is not popular now, you have less interest, so it may not be tested. So
I'm just very weak. The brain has shut down for today.
I understand. Yeah, I understand. We'll soon shut down in the next 5 minutes. We'll run through this. It's just for your information, and we'll close quickly. I understand you've really tried. All right, Aisha, where are we?
I'm sorry, I'm coming. My energy is drained.
Okay, I understand. Just take your time. Take your time. Let's see. If you are calculating and validating, it's good. We are always on the same page and nobody makes
It's also
mistake.
1.1.
Okay, 1.1. All right. Okay, so let me drag and validate. How comes?
What's going on?
We're on the same page, 1.3, but this one is 1.7.
Yeah, 1.007 actually.
Okay.
So that's I approximated as 1.1.
Oh, okay. But 7 is above 5, so I think 1.7. Let's leave it at 1.07.
Okay.
0.03, 7.01. Yeah. Okay, so let's run through what it means quickly. It means that a portion of the company's capitalization is financed through long-term debt. The high ratio signifies reliance on debt financing, which can increase financial risk, while a lower one suggests a more balanced approach to financing. And the implication is that it can raise concerns for investors and creditors regarding the company's financial stability. So internal stakeholders, not external ones like preference, will suggest a significant portion of financing is coming from debt. So this one is balanced. You can see 1:1, and I think there's a balance. So it shows that the liability is the same with the equity, irrespective of external dilution. So I think this one is balanced, and there's no high, there's no low here. And it can lead to higher interest obligations and greater risk of default, especially in economic downturns when you have a high one and you have a low one, indicating more conservative financial strategy. or a balanced one like we saw, reducing risk and potentially enhancing the company's credit worthiness. So the cost of a high one, aggressive borrowing, significant capital expenditures, funding through debt, and lower equity financing. Yeah, the effects, increased financial risk, higher interest cost, potential difficulties in securing additional financing, and higher risk of insolvency. The lower one is conservative debt management, which is advisable. Strong equity financing, retained earnings, increased shareholders' equity, and the effects of a lower one is greater financial stability, lower interest expense, enhanced ability to withstand economic fluctuations. So finally, in conclusion, it's unpopular, but it's a good indicator of a company's financial structure and leverage, analyzing the relationship between long-term debt and total capitalization. So stakeholders can assess the company's reliance on debt financing and its overall financial risk. So balance is also key. Like we saw, 1:1, 1:7, 1:1 is a good balance, indicating maintenance of financial health and ensuring long-term sustainability in a competitive business environment. So ladies, thank you very much. Even though we took more of our time to go and sleep, at least we have closed out on long-term solvency, which is very, very good. Thank you for your